So hello and good afternoon. I welcome you to the special event today, how to trade the market opening of the U.S. markets. Like a like a pro. I think this is how the complete headline reads of this event. My name is Jens Klatt. I've been presenting this format here to you for several weeks, months probably already, and it's exclusively for JFD brokers. So we want to have a look at the market opening in the DAX, but also, sorry, not the DAX, the S&P, but also at the DAX and also the Euro USD. You might have seen that we had some volatile action here, no big surprise. I mean, the thing is that we just had the ECB presenting their statement and what we can expect to get in terms of the asset purchase program here from January onwards. In fact, if you've listened to the morning meetings here from or at 9:30 a.m. GMT, always at the YouTube channel from JFD Brokers, then you are not surprised to hear or to read that the ECB has announced exactly what we've already expected there. So we'll see asset purchases of 30 billion euro per month from January onwards till September 2018 or beyond that. And in fact, it's not that there is a kind of deep research analysis or something behind that, that we were capable of calling that before. But there was already a leak, or let's call it was a rumor spread around 2 weeks ago from Bloomberg and also from Reuters here, which said that exactly that would happen. And if we then look at why they did that, I think it's very simple, because they just wanted to see how markets react to this. And this is exactly the reason why, first of all, they said this, and second, why we were capable of telling what will happen today. And nevertheless, the market reacted in a bullish way in terms of the DAX, and the euro fell off a cliff here. And just have a look right now, recovering some of these losses. Let's see what this means. So the thing is, first of all, the question, why is that? So why do we see this reaction here, even though market expected this already? And usually this is more a chance then to get to see a so-called buy the rumors, sell the facts, or the other way around, sell the rumors, buy the facts. The thing is that they mentioned something quite interesting. 1 second, please. Okay. The thing is that they mentioned something really interesting, and I'd like to show this to you here. So you can see it here. It's a very interesting point, which gives a good reason why the DAX is reacting bullish, respectively Euro initially reacting bearish to this. Draghi says, or respectively the ECB statement says, that the ECB will reinvest the maturing debt here for an extended period after QE ends, so indicating that the balance sheet reduction lies well into the future. So it's complete opposite of what we right now expect from the Fed to take place from October onwards. You remember the statement here in September when the Fed said they will start with the balance sheet reduction from October onwards, and here reinvesting the maturing debt for an extended period after QE ends and holding rates low well beyond the end of QE here indicates that we shouldn't expect rates to rise soon in the future. And with this in mind, and with this somehow clear detail, but this is exactly what I meant when I said during the last days and weeks, especially the last days, when I said the devil will be in the details here. This is such a detail which is perfectly explaining why the market is reacting the way it does. The only question is, will this be a sustainable move? And will we get to see in Euro USD in this case, will we get to see a significant, more significant attack at the region around the August lows, respectively here, the October lows, the region around 1670 to 17? Will there be a move lower here, or at least an attack? And so far, it doesn't look that promising anymore. So initially, it was really a dynamic move, but right now the market seems to recover quite soon from this. Yeah, it wasn't a shock, but let's say from this first reaction here, pushing. One sec. I just have to check here something. So recovering here from the initial drop. Oh, this is interesting. Okay, so so the thing is that here it seems as if right now the market really shows that it was expecting exactly that. And here in this context, we shouldn't probably be too optimistic here about such a drop on the downside. Probably, and as it seems right now, and we have seen this several times in the past, the market is probably about to reverse this this initial push here on the downside, and instead probably pushing back towards and above 118, and probably even higher than that, because all in all, the statement, I mean, it's for me, it's more neutral, or it's more like it's more dovish, let's say. So, but nevertheless, the market obviously is perfectly illustrating that right now they don't expect too much more in terms of more QE here, respectively, more, or a very quantitative approach here. But it's more like, I mean, there is a clear divergence forming, but the market is about to somehow anticipate that rather sooner than later, somewhere in the future, the ECB has to start tapering and to be more aggressive in their taper approach here. On the other hand, I have to say, well, now the thing is, you might say, well, somehow that doesn't make sense, right? So you look at the chart and now you tell a story right around this somehow. The thing is, to be honest, I'm not even sure whether this was really ECB initiated, what we've seen here. So, I mean, somehow we could make a story out of this, but the thing is, probably it has to do with something else, which just happened here. One sec. It's another statement which was published shortly after the statement. Here we have Yellen out of the Fed chair race, Politico says, so ceding a source. So there are right now rumors which are saying that the ECB here, I'm sorry, the ECB, the Fed won't see a Fed chair named Janet Yellen from 2018 onwards. And now remember the options they had here. So the options were some really hawkish guys. For example, this one, I think it was a Stanford professor, I'm not sure, but who said that he sees the current fair rate here of the Fed funds future rate at 5.7%. Instead of currently 1.25, 1 to 1.25, and with this in mind, this move here in the euro probably also has something to do with this statement around Yellen, and probably her being out of, not probably, but her being out of the race for the Fed chair in 2018, and probably a quite bullish US dollar. Because of that, it's also something which could explain. I mean, it's a combination of both in terms of the euro. But if you carefully watch here at the 5-minute chart, you can clearly see that here also GBP came under pressure, for example. It might, GBP was under pressure the whole morning and had some huge selling taking place here with a short big push, if I see this right here, in relation to what happened before, below 132. But all in all, the thing is that you can clearly see that the US dollar here saw some strength, and probably it's a combination of both. And now with this in mind, then probably this move starts to make more sense. And as I already said, I'd really like to step back from going short any pullbacks here, and thinking about shorting in this move with the intention of anticipating a break on the downside. So probably we are about to see another push back towards at least 118 and making back most of those losses we've seen here on the ECB statement, the statement that probably Yellen won't run for Fed chair 2018 a second time. And yeah, so that's one of the reasons why right now I still step back, even though I'm definitely considering short engagements in the Euro USD once we attack this region here around 1670, 117 on the downside. So I definitely consider this to be an interesting level, and a level where I say that with a break lower, I consider chances to be given that we are then seeing a start of a long covering. So remember that in the Euro future here, we've right now seeing the biggest long exposure in the Euro since 2011. So the market is heavily long Euro, and that's something which made this event for today around the ECB very spectacular, very interesting, and could become another big topic once we make it here below these levels around the October, respectively August lows, since this could then trigger the start of a long covering and pushing the Euro lower here in this case. And that's one of the reasons why I still look at this level here carefully and watch this level carefully. And yeah, let's just see whether we get to to these levels here over the next hours. Even though, if you look at the current picture, it doesn't look that promising, to be honest. And probably we need another driver, probably next week with the Fed meeting on Wednesday taking place. Probably here with some rumors being spread that probably the Fed won't hike rates a third time in 2017 in December then. That would be, by the way, something which is definitely considered huge. I mean, look at this here. If you look at the Google and then here Fed Watch tool, you can see that right now chances are, or market participants are pricing in a chance of over 90% that this will happen. So next week, nothing will happen at all. But in December, here, so you can see that the chance here is 98%. So there's a slight chance, but those are the people betting on a rate hike, since these are the guys you will definitely call. If you're a journalist, you would call them and ask how they came to the conclusion that the Fed will hike rates. So, and if it's just 1 out of 100, you're doing where you have the chance of becoming what's the word for this? Becoming famous, if you want, here overnight, or over one Fed event here. But look at this here, it's 96 or 97% that they will hike rates. So this is the current level, and this is what the market is expecting here. So right now, it's 97% that they will hike rates. And if there's any hint that they won't hike, or that there's a small chance that they don't do it, this could then trigger some definite US dollar bearishness here in this case, and by the way, not resulting in a break on the downside. I'm not sure. I'm sorry. I think I just mixed this up here, and that doesn't make sense. So in this case, US dollar would become would see some huge pressure. That's what I want to say. And the moment we see huge pressure here, then this break on the downside is definitely off the table. On the other hand, right now, if you look or remember the dot plot from the last meeting in September, we also know that there's a chance of 2 hikes in 2018. which means nothing more than if there's now coming in the chance of a third hike, that usually mean that the US dollar could take off. And in this case, we could then see probably some further US dollar bullishness, which then, by the way, means nothing more than here we get probably a quite strong attack at the level around 94, which in the US dollar index future is the support for this down structure. Support, I mean, it's a resistance, but what I'm talking about is it's a support in terms of this structure falling highs and falling lows. And this structure would be broken once we make it back above 94. So holding this structure in place, supporting this structure. And if we break above this, well, then I'm saying it's at least interrupted. This downside structure is at least interrupted. And this could trigger then some further losses in the Euro USD. And I think the thing is that those two breaks would coincide with each other. So US dollar making it above 94, while the Euro USD is making it below 116.70, 117 around. So okay, that's it on the US dollar, respectively Euro USD front. So right now it's wait and see, and we don't have any reason to take any actions here. But in fact, I'm holding a long position in the DAX, but it's a systematic trade. So it's not because of the ECB or something, but I'm right now along the DAX here. You can see this. So this is the Euro USD, and you can see here a long position. It's a systematic trade. I'm trading for my clients. And what I already did is I moved the stop to break even. That was already before. So here was the bullish move after the statement from the ECB was given. And yeah, then, well, what happened? Nothing happened. So in fact, there was no real follow through. Right now, the market is stabilizing at a quite elevated high level. Let's see whether probably US markets can give us some further momentum here on the upside, probably pushing us higher, probably. And the thing is, we are still in a range where here, this is a quite significant region, in fact. So even though that doesn't look that promising, it's a range-bound market, and we are in midst of a range which is broken once we make it above 13,100, or if we break below 12,900 points. So in fact, we are also here trading in the middle of nowhere. But, and this is the thing, if we make it another 20 points higher here on the upside, 20, 30 points higher on the upside, so breaking up to 13,050, 13,060 points, there's further room for another attack at those all-time highs here. And if you carefully watch what the US markets did yesterday, they somehow clearly showed that they're not yet willing to go down. And as long as volatility stays low, you should be really, really careful with short engagements. Even though yesterday I formulated the setup here for the S&P, which played out really well, and hit the target before we saw this reversal then. So yesterday, this wasn't something I presented to the English-speaking community, but for the German-speaking community, I said, well, look at this open range here. So we are triggered with a break below 2,559 points. And then working with a stop here above the highs, which are here 12,564.775, and then we aimed on a target on the downside at 2,545 or 43. So the thing is, one second, I'll do the following here. Let me just show you the tweet here. So it's a German trading chat box. So, but probably you might say, okay, could you please show this to us instead of just saying you just made it a topic? So here you can see this. This is 2:34 p.m. GMT, and here's the setup. So it's 2,558.75. The stop 2,564.5, and then we aim 2,545 here in this case. And this played out really well. The market hit the target and moved lower here. And now the thing is, but it reversed then. It started to reverse and didn't make it lower. And if you carefully watch it, what's going on here in the Dow Jones, that's the same thing. So the Dow Jones here has seen some selling of something like 200 points yesterday. So let's go here for the 50-minute chart too. So you can see here, that looks quite impressive, even though this drop is not 1%. It's not 1%, it's 1% move. So in fact, by the way, Let me just give you, that's not in terms of the Dow Jones, but in terms of the S&P. So I have a statistic here showing you how long it right now takes for us to make a 1% intraday move in the S&P. You can see it here. It's 35. Now it's 36, in fact. That was yesterday. So 36 trading days that we haven't seen a 1% intraday move here from 1962 till 2017. The longest period, by the way, longest streak was from the 15th of December, till the 20th of March this year, with over 60 days with a 1% drop. So showing, or perfectly coinciding with the with the fact that we are currently seeing the least volatile market environment ever. We haven't seen such a low volatile market ever in history. And that perfectly fits this picture here. But the thing is, and that's what I want to talk about here, you see that the market recovers quite impressive after this drop. So meaning nothing more than right now, I'd definitely be really careful with anti-cyclical short engagements here in the Dow Jones. So even though we're hugely extended, and even though the risk reward on the upside is definitely not really attractive, it's a matter of fact that the bulls are still in play, or that the bulls still have the advantage on their side. And that's one of the reasons why you should be really careful here with short engagements. And by the way, the thing is that yesterday I said, well, there are two things you could consider here. So when I trade the open range breakouts, what I will present to you in a few minutes, in a few minutes here, then usually I hold the position till the end of the trading day, which means I automatically close it at 7:50 p.m. GMT. That's 10 minutes before the US equity markets Wall Street closes. So the thing is that yesterday I said, well, probably it's better to work with the take profit, especially here on the downside. I wouldn't do this on the long side, by the way, and keep on the position here and just hope that the market will turn a bigger profit here, since it keeps on running, since there's obviously no big seller ahead here and holding the market from making new all-time highs here. But if you consider trading the short side for whatever reason, and again, I wouldn't prefer to do it today, but if you do this, if you really prefer to trade the short side, then I think it's a good idea to look for a take profit here. Even though the thing is, and this is the other thing, similar to the DAX, now the region around 2,540 here on the downside can be considered quite significant. So I think this region here coincides with the region around 12,900 points in the DAX. So meaning nothing more than if it breaks, I think it will heavily break. And in the S&P, this could coincide with a drop down towards 2,500 points, while a break of 12,900 in the DAX, for example, could coincide here with a drop for another 200, 250 points, and pushing the DAX as low as 12,680, 12,700 points here. So towards the region around the July highs. You can better see it here if you see this level. So from a risk reward perspective, once the market attacks this region, it could be really interesting to consider aggressive short engagements, probably also with a tight stop here, trying to probably get the most out of such a move here by also raising the position size, working with a volatility stop of something like 20 to 25 points, and then just expect a quite huge drop to happen here. This happened several times already in the past. For example, I'm not sure. Was it here or was it here? I don't know. Probably was here. Probably that looks good. And that was 12,300. So the market dropped here below that level. That was, for example, such an example where I traded the break aggressively short with a stop of something like 30 points, moved the stop to break even. Unfortunately, it didn't play out well because the market really reversed after dropping 60, 70 points in my direction, coming back, stopping me out break even, and then turning turning lower again. That was really unfortunate here, even though it perfectly shows what you could consider once the market really moves to these levels. It's still, if it happens, rather sooner or later. There will be probably some day in the future when this happens. That doesn't need to happen today or in the next few trading days. Could take weeks till we finally make it to this level, but definitely it's worth watching this level. So 12,900 once we make it to this level, respectively the region around 2,500 and 2,540 points. Or 545 points in the S&P. Those two levels are probably really interesting. So yeah, that's it on the market. So you probably wonder what do I plan to do here with this trade in the DAX? I plan to hold it. So that's on the stop management of this trade. So it's a systematic trade, as I already said. And now the target is to somehow, yeah, first of all, get the most out of this, but on the other hand, hold the position and write the position as long as the system says, okay, I take it out, which will be at the end of the trading day, in fact. Probably in the meantime, I probably start to trail the stop once the market really starts to extend on the upside. That could happen once we make new all-time highs. We see some kind of huge squeeze on the upside, pushing us, I don't know, to somewhere like 13,200 points. This could then lead me to probably to manual profit taking here. But all in all, usually I will just hold this position and also hope here that the US markets will give the position, which is already showing a profit here, some further momentum, even though the risk is nothing since I already moved the stop, trailed the stop to break even. Yeah, so that's it on the DAX. So we are 4 minutes away from the US market opening. Before we open the market, the market opens, I'll already answer some questions. So 1 sec, please. Here is the S&P on a 50-minute time frame. I present to you the setup in a few minutes. So first of all, here, let's have a look. Okay, no questions so far. Okay, perfect. So then let me just do the following. Okay, so yeah, let's come back to the PowerPoint then here. 1 sec, still open. So here, first of all, the setup. In 1 second, I just have to see here. Okay, that's great. So that looks good. Okay, so let's have a look at the setup we plan to trade, and we'll go into further details here on the profitability of this approaches a little later. But you can trust me, it's a profitable trading system, even though it doesn't look that complex or spectacular. But this is something I'd like to remind you of here for the future. Systems which are robust and which are usually profitable are easy systems, in fact. So it's they are duplicable, they're easy to trade, and they're easy to understand, and they have clear predefined rules you just follow. And even though when reading trading books or when reading through trading forums or following guys on Twitter, if you watch the charts of these guys, usually they look really, really spectacular. So colorful, so many colors. And by the way, I just want to show you one chart. I found it on Twitter, and I want to share it with you. But 1 second, I don't really know where I have it. So that you have a better idea of what I'm talking. Yeah, perfect. There we go. That was easy. So you think that a chart probably has to look like that, right? And if it doesn't look like that, well, the system, whatever system might lay here in those lines, you might think, okay, if a chart doesn't look that way, well, the system can't work. And you have to have tons of indicators here, which are then showing you the right direction of the market. And nothing is more far from the truth than that. So in fact, trading systems which work, again, they have predefined rules. They don't allow you to misinterpret them or something like that, and they are easily duplicable. So in case of the open range breakout system, for example, and it's a system which is, by the way, already traded for at least 30 years, if not longer than that, and it was, let's say, it was invented, even though it was just discovered, probably. I think discovered is a better word than that, than being invented here, from a guy called Toby Crable. And so the system itself is based on the fact that you just look for a range to develop during a certain time span, and then trade the breakout of this range here, and that's it. You see, so meaning in the case of the open range breakout system, for example, in fact, I think it's the wrong it's the wrong order. So 1 second, I just do the following here. I'll just switch this. 1 second. So let's do it that way. So first of all, I'd really like to define the open range, and then we identify the advantage. So we define the open range between, in this case, 1:30 p.m. and 2:15 p.m. GMT. So right now you look at the at your watch, and you'll see that it's 1:30 p.m. GMT. So the definition phase, let's call it, just started right here. And nevertheless, we have to wait another 45 minutes till we have a range, which we then can take as our basic for this for the strategy, to trade the strategy. In fact, I've presented this already last week, and I want to emphasize this again. During the last days and weeks, I haven't seen many trading setups over the month of October, even though the month of October usually is one of the most volatile months in the history of the markets, equity markets. And that has to do with the fact that volatility is really low. And even though I present the basic setup to you, I'll just give you, or I'll already give you a hint why I, for example, don't trade every range. And that has to do with the fact that I have a trading filter included here, which says I need at least this range between 1:30 p.m. and 2:15 p.m. GMT to be 0.2% of the current index. So meaning, in case of the S&P trading right now at 2,500 or 600 points, I need this range to be something like 5.2 points. 5.2 points, yes. And if it's smaller than that, I don't have a setup, because the range is too small in comparison to the spread you have to pay. So meaning that you have to have at least a range of, in this case right now, 5.2 points for the S&P, even, or else you won't get a setup here, because then the range is considered to be too small to trade it. And this is, by the way, also kind of a volatility filter. So usually breakout systems usually work really well in trending markets, if you then trade the market in direction of the trend, and you can really well capitalize on those trends then. But if the market is in such a choppy range here, just drifting higher, just seeing small breakouts here, like we've seen yesterday, for example, let's take it on the downside. And even though you might say, hey, is the advantage really to be found on the downside in such a market environment? I think so, yes. And that has to do with the fact that the market is already really extended on the upside, and risk rewards are getting unattractive. But here, for example, the break occurs then on the downside. Let's say we just considered the downside, the short side, to be more attractive from a risk reward perspective than the long side. If this happens and the market pushes lower, the thing is that the market right now has the tendency to make back most of those losses, especially on the downside. That's a pattern you can easily spot when looking at the U.S. equity markets, and that's one of the reasons why, for example, it can make with a predefined stop loss, not stop loss, but a take profit in this case, then trading here with the whole day and just hoping that there will be a trend developing, or a trend which develops then over the next hours of trading, because usually this doesn't happen. But instead you get just those, let's call them V formations in the chart. So So the thing is that, again, in a low volatile market environment, such breakout setups usually do not work really well. And that's one of the reasons why I have already a filter here included saying I want to see at least the range, this open range, to be minimum 5.2 points. Because if it's lower than that, volatility is usually really low, and this usually makes it really difficult to trade this setup here profitable. And next step, you identify the advantage. So if you have a range which is wide enough, well, usually then you have two chances of identifying an advantage. What we will do here is the second one. We'll work with the exponential moving average 10 on a 50-minute time frame, and easily saying if we trade above that, we're going long. If we trade below that, we're going short. There's another idea here, which is based on Dow theory, rough Dow theory. And here it's coming into play what I already mentioned here. So like you have a structure of higher highs and higher lows. It's an uptrend. And usually you say, hey, that's what I trade long, right? But the thing is that, the higher the market rises, the bigger the chances that there will be a pullback, because those market participants buying in those retracements here and pushing the markets to new highs are considering this region to be quite unattractive to go long, because the risk reward is getting unattractive. So usually that will naturally, in an uptrend, result in the demand diminishing here and supply overcoming the demand, resulting in a pullback. And that's one of the reasons why, if you see the market trading in the so-called distribution area. So what I usually teach my students, those who are interested in becoming professional traders here, I offer an online educational course. And there's also something included here, even though it's just a rough overview, since it's my focus mainly lies on the topic of really giving you the input you need from a theoretical perspective, especially here, to build a solid risk and money management fundament, a solid mental fundament, and also what it takes to create an advantageous and profitable trading strategy. And then based on that, on these three columns, you can really become a professional trader. And it's especially in terms of the advantageous trading strategy, profitable trading strategy, market structure, or Dow theory, if you want to have it a little broader, and also sentiments, like sentiments in the FX markets, positioning of certain market participants. They can be used to identify advantages, and based on them formulate trading ideas. That's one of the reasons why I make this a topic, but it's not the main topic of the courses I offer. And so the thing is that I call this region here in this green area the accumulation phase, accumulation area, and then everything above the former highs here, it's the distribution area. And so usually this is then one of the reasons why I could consider taking short engagements here, even though the overall trend is up. So that's one of the reasons, or one one of the things I'm talking about here when talking about identifying the advantage. And then what we do is simple. We just trade the break of the open range in direction of the identified advantage. Stop above, respectively below the high low of the range. That's it. So the thing is that we have to wait for such a range to develop here. But if you look at the example from yesterday, for example, what I've already said is that, and here we have the numbers, we have them prepared. Oh, that's great. Look here, DAX is pushing higher. I love to see that, to be honest. So by the way, what's happening to the euro? That's what's more interesting. That's perfect. I really appreciate this, and probably will make it to new all-time highs here. But what I like to see is what's happening to the euro. Euro making new lows. This is now getting really interesting. So let's put the open range setup here aside for the S&P. Let's just first of all have a look here what's going on. So euro is aggressively lower. Let me just have a look if I can find anything on Twitter here which probably indicates why this is. Okay, this is interesting. So obviously again, here, what you can see here is that the US dollar right now is ripping based on the yield developments around potentially Janet Yellen resigning. Okay, but nothing more than that, right? I love that. Really, it's great. So the thing is, I mean, everyone knows the word here in German, right? This is usually the first word you learn when you come to Germany. And by the way, I bet that my son will say the same word instead of mom and dad here, but instead it will say this. I won't say it here, but what's meant by this? Well, Deutsche Bank relies on higher rates because they make money, or banks usually make money out of higher rates. It's very simple. It's a simple approach. And the more yields are under pressure, the more difficult it becomes for a bank to make money. So the numbers here around Deutsche Bank from today were okay compared to what happened last year. But all in all, the numbers indicated that they have trouble to really gain momentum here and make money in such a low yield environment. And the thing is that obviously here 10-year Bund is ripping while yields are crushing right now. And this is something Deutsche Bank in this case doesn't like at all. So where's the Bund? Here. So what you can see here is obviously Bund being long, even though the structure itself, it's consolidating for over or nearly a year right now. So we're not seeing a structure similar to what we've seen here from especially 2015 onwards and before that, when the Bund just made one all-time high after the other, showing a very strong uptrend. And nevertheless, today also yields are crashing, and right now it seems as if this is something which is now playing out. So I was wrong. I just have to say I was wrong. I said when we started with this event for around 45 minutes ago, I said, well, probably after the market made back most of those losses here, probably we see another move up to 118, since the market obviously seems to not really take care of what was just communicated from the ECB. But now, obviously, the market starts to see a quite dovish statement from the ECB and considers it to be dovish, which means we are probably about to see a quite significant move lower here towards 116.60, 117 on the downside. Again, even now, the picture looks more promising for the bears and those betting or waiting for this break to happen. But right now, it's too early to consider such an engagement. So what I could think is that probably we move to this level, probably see a small pullback and then move lower. So it could be that this will happen then over the next hours here, but not necessarily today. But just let's see. I want to be honest, I'd really love to see today, even if I'm probably not trading such a break. But you can imagine that I'd love to see euro crashing, since this is usually negatively correlated to what happens in the DAX, meaning the DAX should go up. And as you remember, I'm long. So this makes chances quite good that today, or increasing chances that today we probably make it to a new all-time high, which is not the worst thing for my current long position in the DAX here. But just let's see. Let's come back to the S&P first, since I really want to give you the input here so that you can closely watch and follow the price action and probably formulate a setup yourself then. So again here, that's something we need. So here's the range. It's 564.5, 558.78. So if we, oh, by the way, 1 second, is it here? No. Okay, I'm sorry. So usually I have an indicator drawing those lines for me, but in this case, it's not the case. So 564, 1 second, where is it? So let's use this as an example. So here is the high. So I'm not drawing it right on the red line, since this is the daily high from yesterday. And then you can duplicate this and use the low here. So this was the open range yesterday. Okay, so showing the high and the low of the time span before, I'm not sure. Okay. Of the time frame here between, again, 1:30 p.m. till 2:15 p.m. GMT. So, and now what you see is that the market breaks here on the downside. So what is the setup? Let me do it that way. Probably that works a little better then. So, so the setup was to say we identified the advantage based after this range was developed here or developed. We identify the advantage based on the Dow theory, or in our case, via the 50-minute EMA 10. We're trading below that, so meaning we are only trading the short side, and then we trade the break out of the open range in direction of the identified advantage. Stop above, in this case, the high of the range, because we're trading the short side. So we are entering the short here, we're placing our stop here. And then, in this case, worked out really well. The market moved in our direction. And two chances. First one, or two take profit opportunities. First one is work with the take profit, which worked out better yesterday, or leave the position open till the market closes, respectively 10 minutes before the market closes, and then close it wherever it may trade. And that's it. So in fact, that's it. So very, very easy, very simple setup. And now the thing is that you might say, well, does it really work out? Yes, it does. And okay, so one thing. So repeat how you calculate the acceptable opening range. That's something I'd like to show you first here then. So look at this current reading of the S&P, which is 2,563. And I take 0.2% of this, which is right now 5.126, okay, 5.1 points for the open range. So I take 0.2% of the current reading of the index, which is here this green thing on the right column. Okay, so and if you take 0.2% of that, you see that the open range has to be at least 5.1%, if 5.1 points. If it's not 5.1 or lower than that, that means nothing more than we don't have a trade. So even then, if we can easily calculate the high and the low of the range here, but we are not trading it. We only trade it if the range is wide enough. In this case, 0.2%. Okay. And now the thing is, again, some might say that this can't be profitable, but it is. In fact, it is. So let's have a look here at a backtest of the strategy back towards November 2010. In this case here, showing that the equity is obviously positive. And also here you can see that we're working with an exponential moving average of 10. This is this indicator here. And you can see that the hit rate, for example, of this approach is 47%. Meaning here that within a payoff ratio of 1.3 to 1, payoff ratio is given thanks to the calculating the ratio here of the average profit through the average loss. And then you get 1.3 to 1. You get an overall expected value of 0.08. 0.08. I'm sorry, 0.08. One second, I just write this down. Okay, so the expected value is given through the average gain multiplied with the hit rate, and then you subtract the average loss with the loss rate. And here, you can easily include those numbers. Again, average profit through the average loss. We make things easy here. We say that this is 1.3 to 1. So I've calculated this before. It's 1.08, and you divide it by 0.82, and then you get 1.3 to 1. And the thing is that you just include here a 1 then with the average loss, which makes things easier to calculate. And the average gain is 1.3. You multiply this with 47%, then you subtract 1 multiplied with 0.53. So it's obviously that those two numbers here, average, the hit rate and the loss rate, have to sum up to 100%. And what you then can see is that here you get one thing. It's, I think, 6.1, right? Yes, 6.1. And here you subtract 5.3, and you get 8 points. So this means that you're making 8 cents per every euro, US dollar, British pound, whatever you risk per trade. So meaning if you're risking, let's say, 1,000 euros per trade, that means that you're making, on average, it doesn't matter if it's a winning or a losing trade, you're making 80 euros per trade. And if you do this over and over again, and in this case here, we are talking about over 1,000 trades we did, you can see a clear up structure here. In fact, it would look more promising the moment we work with one second, I don't know. I just know the German word for this. It's Zinseszins. It's yields. And 1 second, let me just. So it's Zinseszins. Compound interest. Yeah, I'm sorry, it's compound interest. So not working with compound interest here or something like that, but instead we only calculate the R if you want. So the payoff here would look way more promising. And now the thing is, you can. The great thing about such a backtest here, if you have such a detailed backtest, and the thing is that is also something you have to remember. I mean, the setup itself here. It's very simple. You can easily automate it within, for example, Expert Advisor, and then run it through the MetaTrader, here the strategy tester, and get numbers for an extended period of time. So in fact, on my website, you can find this exact same strategy. 1 second. It's jk-trading.com, and you can find the strategy here under the tab. So it's a German website, but some parts were translated into English here. For example, the DAX strategy. The strategy can be adapted to several markets. And I did this for the DAX, for example. That's one of the reasons, or one of the reasons why I did that was because we have the DAX long or short usually taking place every Monday and every Thursday in English here at 7:20 a.m. GMT. And here you can also see that you can not just adapt this, but what you get then in terms of a report. Some of you might have worked already with this, and what you can see here is, okay, taking a little, yeah, here. So this is what you get then. So this is what you get, so very detailed. And the great thing about this is now, and this is where the work starts. So you can already see what it takes to build a profitable trading strategy and how to adapt it to your personal needs, your risk aversion, and all that stuff. The thing is that you can work with those numbers and run simulations, for example. So you can backtest a lot of stuff here, a lot of strategies. But another thing is that nevertheless, you only have the data available here for a certain period of time. And it doesn't tell you if this is always the case, but usually market conditions change, and such a change in market conditions result usually in a different payoff here, in a different equity curve, and you get another drawdown, a potential drawdown. And there are equity curve simulators, for example. You can work with so-called Bernoulli distributed Monte Carlo simulation. So we are going in very detail right now, but let us just run this here. So we can work with those numbers since we have those numbers, And it's a German tool in this case, but I bet it's available in English too. So you have a starting capital here, about 10,000 euros. You have a hit rate of 47. You have a 1.3 to 1 payoff ratio. And now let's run 1,000 trades here. Let's just see what happens. And let's just simulate 20 equity curves. And you risk 1% per trade. And now you start the simulation and you get some real nice numbers. So all of these are simulated equity curves based on the input parameters you use from a real backtest you run here. The great thing about this is the following. You can see, for example, that the max drawdown here is 33%, or 33.9, 34%. So while the average max drawdown is 21%. The great thing about this is the following. So if you now say, okay, well, this is probably a little too much in terms of a drawdown, well, you can easily reduce the average risk per trade. So let's say 0.5%, and adapt the strategy to your personal risk appetite here, making, for example, reducing the average, the max drawdown here to 21% then, and reducing the average max drawdown, for example, to 11.5%. This is, by the way, also something very, very interesting, something very, very important for money managers, which are giving in. I mean, if someone wants to invest money here with a money manager, and I'm managing clients' money too. So someone comes to me and says, "Hey, what can I expect?" I can't tell him what happens in the future, but what we can do is I can use all the numbers from my trading. That's one of the reasons why you should also have a trading journal, very detailed trading journal, and know your strategy, your trading, or all of your strategies at best here, combine them, see if you can diversify your portfolio and so on. And the thing now is that you can give him an idea of what he can expect if it really doesn't work his way, even though that drawdown could be bigger or could be smaller. So here you can run several simulations. Now we are already at 22.4%, but you can see that the average max drawdown is somewhere around 12%. And that's what you can tell an investor. And this is usually also something which calms you down, not just as an investor, but also as someone who is trading his own account. So if you know what you can expect, based on a solid backtest and based on the strategy you're running here, you really know the strategy, you know all the parameters, and there's no real room for you to trade the strategy. Well, then what happens is usually you really can trust the system even more than you probably trust it already, since you invented it or you formulated it yourself. And this is something which is enormous. It's so important. Because you are not, well, you're probably there is still a chance that you're getting emotional in your trading. But the thing is that usually you will come down to a point where you know, okay, I can expect those things to happen. For example, also not just in terms of a drawdown, but also very interesting here, like a series of losers in a row. It's 17. So just imagine you're losing 5 times in a row. I bet you're going completely crazy and just think, okay, the system doesn't work anymore. If you run this here over a series of 10,000 trades, well, you can see that this is normal, and you have to really adapt your risk management to this, or money and risk and money management plan to this, and deal with it. This is where mental stability comes into play. But all this, if you combine this, you can easily see, you can spot that it's really important to have a clear idea of you have to have a clear idea of what you're doing. And this is one of the reasons why you should be really careful of overcomplicating things, but instead work out a system which has clear parameters to it, which is not overly complicated, and then test it and see whether it works and adapt it according to your personal risk appetite. Yeah, and so that's it here around this strategy. Let's just see what happens here. So far, I can say that the high 2,563, the low is 59. Well, it's 3.5 points. We need another 1.5 points on the up or on the downside to have a range which makes it possible for me to trade the S&P today. since else we won't have a range of 5.1 points, 5.1 points. Yeah, making it impossible for me to formulate a setup. Yeah, just let's see. That's another 50 minutes to go. We have to wait. This is the moment when this webinar ends here. Let's just see what the DAX does. I love it. Really, I do. I mean, this is exactly what you want to see, right? If you're long and now the market is trending higher. While on the other hand, let's have a look here at the euro. It stabilizes slightly above 117. Again, the key level is the region around the October lows, the August lows here. And we are probably about to break the neckline here on the downside. Let's just see. Yeah, so that's it from my end. I hope you enjoyed the event, and talk to you again then next week on Thursday, again here with a live trading session around the US market opening. And so yeah, so that's it. That's it from my end. I read through some questions here. Do you scale in, scale out? Yes, I do. But right now it's not the time to discuss this probably. So we could easily discuss this in some further events if you're interested in this. So just shoot me the question right at the beginning of the event. I can easily guide you through this, how I do this. And there are some rules you can live by, some effective rules you can easily adapt to your trading. Repeat stop loss and take profit rule here. So it's the third point. The stop loss will be placed above the high in case you're going short, or below the low if you're going long of the range you identified here and defined in 1. Yeah. And the take profit rule depends on the market structure. The system here I just presented to you has an exit rule, which just says you're automatically closing out the position at 7:50 p.m. GMT, so 10 minutes before the US markets close. And yeah, so that's it from my end. I hope you enjoyed this event, and if you have any questions, please shoot me an email or send me a message via Twitter. It's at Jens Klatt FX, so you can see it here. And where is it? Here. And yeah, so that's it from my end. Happy trading. What's your stops? Talk to you again in 1 week. I look forward to it. See you, and bye-bye.